Hi, you're listening to Avenue Insights. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
I thought for today's conversation, we can go back to one of our conversations from about a month ago, really when, the beginning of April, the market was still coming back from that, tough period during March. And I think the view, both from market commentators or, from a lot of people in financial media, was that the market was instantly going to go back down and touch the lows again in March. And so now we're on the other side of that here in the beginning or middle of May now. And we've seen even further policy response, both fiscally and on the monetary side. And so maybe survey the landscape in terms of what you've seen the last, few weeks to months, both from a market perspective and a policy perspective, and then maybe hit on some of those sentiment things that we were talking about a little bit earlier.
Right. Yeah, it's been an extraordinary period of time. And I think if we and we'll touch on this a little bit later, but it's the speed with which we have gone and how fast you've got to think, and really just saying the decisions you have to make to manage your way through this. And it's not let's just be patient and wait and see what's going to happen, because by that point you've missed it. Mm-hmm. If what you're going to do, how we want to get set up. So I think it's really to frame it that way. I've made a couple notes today because it's even that simple question. Man, we've got so many moving parts. Yeah. We come in the morning and we're constantly discussing all these different pieces. And so I think the overlying theme to discuss with this always is, we've talked about this at even like the Avenue events in the past, is that the stock market really doesn't represent the economy. The two things are separate, and a lot of the mechanics of how they work are really exposed in this time. And so I wanted to start today with just sort of dissecting, now that we've bounced back as much as we have, is this crazy? And this is the whole idea. You look out the window, or watching TV, just sort of going, this is the single largest economic event that we've had in our lifetime, if not 100 years. And the greatest thing in England last year, they said the worst event in 300 years. Yeah. So how on earth can the stock market still be holding in? And so it comes down to the structure of the stock market. So we're coming in not terms of Canada. Canada is such a messy stock market and index. We have basically banks, insurance, resources, and we have Shopify. So now just as term an index. So it's thinking about the U.S. consumer industrial economy with a consumer industrial index, but it's consumer banks, and really it's technology and the weight of it. So the S&P earnings on the S&P 500, the biggest companies in the U.S., were going to be hopefully 170 to 180, highball this year.
That was beginning of the year.
That was beginning of the year. Yeah. Right now, the expectation of today, and this is a moving target week to week, is around 100. But as we've talked about on the past times, is really the stock market is can look 9 months ahead and even a year ahead when we're in this type of a crisis. And so we're looking at earnings next year of about 150. So we've talked about, in a low interest rate environment, the average multiple, what the stock market will pay for the $150 historically is around 16, 17 times. Interest rates are so low, you could say, well, could they trade at 20 times earnings? And which is reasonable. 20 times 150 is 3,000 on the S&P 500, which is basically where we are right now. Yeah. So thinking, is this crazy, or is this actually kind of logical? And then you just go through, well, how realistic is the 150? And that 150 earnings really is dominated by Microsoft, Google, Apple. And if we were really spent the last week, and commentators and the industry saying, well, if the stock market and the structure of the stock market right now, those type of businesses were almost built for a pandemic. Thinking about Amazon. Amazon has taken off. Yeah. But those are dwarfed in their size of the S&P, but they also dwarf the earnings of the S&P. So, but really, what our conclusion from that is, don't think that you're diversified.
Right. The S&P has become a very concentrated momentum strategy, and it's not a diversified strategy like people think. I think the one number that you keep looking at is also what has the overall index done with the weights that they are in the Apple, Amazon, Google, Microsoft, but on a more equal weight basis. And I think the spread, say, between the two of them is almost a 10% spread between what an equal weight index has done on the S&P versus what the S&P is now with those mega cap weights. But it shows you sort of the distorted effect that a lot of that index concentration has, and how, rightly or wrongly, the index has become, a momentum strategy with, as you mentioned, the top 4 names are almost built for a pandemic kind of economy where you don't really need underlying economic growth over short periods of time for those companies to still do very well.
Well, I think you were hoping to show one slide, which is showing that those handful of
well,
stocks, like handful meaning 5 stocks, are about 20% of the index.
Yeah, we'll put that up when we edit it. But it's I think as of the end of March, it was almost 20% of the index of those 5 stocks, which is so if the index is, say, round numbers 25 trillion, at the beginning of the year, 20% of that's almost 5 trillion in just those few companies. And
right.
It's a staggering number.
And I think we might come back to that point, but just to touch on it, because you already, just did, which is the average dividend investor in Canada, or taking the S&P 500 and saying each company, instead of saying proportional, which is Microsoft is 5% of the index and Apple is 5% of the index, you say each company has the same weight within the index. The average stock in the U.S. is down about 25%.
Yeah.
So there still has been, that's the average.
The median.
The median meaning 50% of them are worse than that.
Yeah.
Really, this has been so it's to say that saying that how can the stock market not be down more really exposes how structurally different the stock market actually is, as to saying this isn't an economic wipeout.
Yeah.
Because really there's parts of the stock market that are completely demonstrated.
Obliterated, yeah.
Yeah. Well, absolutely. It's the hospitality, hotel, cruise ships, airlines. It's incredible. But also what's happened is a lot of that money, which was in that part of the stock market, has to find a home. And coming back to, we'll touch over and over on this, but with the bond market being taken away, having such low interest rates, money has to find a place to live. And so structurally, it's got to move away from those clearly weak parts of the economy and move. And even though, you and I, and we certainly think our money is important, but there's just scratching this down on the weekend because there was an article in the Globe sort of saying, what are the big pension plans in Canada doing? But it was just a simple math exercise of saying from CPP to Teachers, Case, Alberta Investment, and BC, it's 1.2 trillion of assets, and the size of the TSX Canadian stock market is about 2 trillion. So it's an incredible amount of money institutionally that has a much different time horizon. That if we're nervous about the market right now and what's going to happen in the next 3-4 months, a big pension fund really is taking a 30-year bet on having their assets and finding businesses that they can park their money to get that compound rate of return.
Right. The other thing you touched on a little bit there, but we can get into a little bit more, is looking at some of the policy response as well that's happened since we spoke last. But you've seen it in Canada with some of the support measures that have been there, the staggering amount of government debt being issued, or deficits being issued. I think the number I was looking at the other day in the U.S., I think for the month of April, the deficit was almost 800 billion, 760 billion or something like that, I think. And so you're running at a rate that is going to be, upwards of $4 trillion deficit in the U.S., which is about 20% of GDP. And I think in Canada, we're going to be somewhere maybe in the mid-teens. And then also on the central bank side, you've seen more support. Both Bank of Canada is now buying corporate bonds. And then in the U.S., the Fed started buying high yield bonds and corporate bond ETFs, I think, last week. And so you're seeing, to your point earlier, of where financial markets and the economy can at times, go in opposite directions. And, over long periods of time, of course, what the underlying economy and your profitability of your economy matters for the stock market or for asset markets. But in these short-term periods where you have unprecedented levels of money being stimulated into the economy, the first place that you see it is in monetary inflation. And I think that certainly is respective of the market move that we've seen to now in the middle of May, but also why a lot of this defies logic, because for individuals or for clients or for, other people throughout the country, looking at your local economy saying, how can the stock market be where it is based on what I'm seeing, on the ground, whether it's, retail closing, restaurants that are not opening, or people being unemployed. And so there's this huge dichotomy that I think a lot of people are looking for an answer to. And so what would be, some of the things that you would talk to about how we're at that point, maybe from a policy level?
Right. And then this is the problem, is that the restaurant and hotels sometimes, but all the entertainment hospitality sector really is not represented in the stock market. And so going back to, it's whether the media will cover Trudeau announcing a program, or the central bank program, or in the U.S. Central bank doing policy after policy, and it's hard to add them all up and come up with a simple number. And so what we're addressing first is that because became worse, I would say there were certainly some people that thought it was expected. It's not to relive this too much, but certainly our own expectation was you shut it down, you find out who's sick, who's not, and then as you started going through March, we discovered that, half the people were passing it on without anybody else, and this much have a much longer tail than anybody expected, except the market discounted all that so incredibly quickly, which means that if a panic was because if you had borrowed money and you had to get on side fast, like why it was just a tearing the Band-Aid off was that, if you're in a trading situation saying, I'm too exposed, I can't afford to be in the market, and I've just got to tear the Band-Aid off. So that the market reacted just so incredibly quickly, cleared the market, but then all these policy responses happen equally as quickly. And the scale of what we're doing today, and again, we won't know, as I said, if the economy continues to linger and get worse, and with there's more policy stimulus, but you basically created a 10% GDP hole. This is the simplest way of sort of simplifying or visualizing what the problem is. Here's the size of your economy, and then you just dug a 10% hole in it, and then all the government policy has filled that hole with 15% more money. So you actually have a surplus to what you've taken out. And that money in the short term, the monetary stimulus, is the money actually has to go somewhere. And again, bringing up the point is this: historically, you would say, I'm nervous, I'm going to sit on the sidelines, I'd sit in the bond market, but interest rates are so low, the bond market's been taken away from us, and we haven't been able to use it as a tool as effectively this time. And so you've added more money short term than you've needed, and again, it's come in and propelled the stock market, but it's really driven in that narrow group of stocks that are what we normally call recession-proof, or really what we've seen as like pandemic-proof.
Right. The other thing on that note, with the amount of money that's been created, I think the number we were looking at the other day so M2, which is just a sort of a jargon term for the amount of money that's actually in the economy created through the banking channel, is up, I think, close to almost 20% year over year in the last month, which is, if you go back for 50 years, is the highest ever. Like the amount of money I think that is created or has been created in the last month, I think is unprecedented. And even I was with someone on the weekend who asked me the question of, where is all this money coming from? Is it, I keep hearing about all these different policy responses, but I don't understand where the money's coming from. And then we were talking about this earlier, but watching 60 Minutes last night with Jerome Powell, and he very candidly said, yeah, we print it digitally, basically, and you flood the banking system, which then gets flooded out into the market, which then leverage players can take on, or you cover some of your leverage, or it just flows into the market through a spillover kind of effect. But it's all just been created synthetically. And then the policy or the debate you're hearing on the fiscal side politically is now saying, okay, well, maybe we should tighten up a little bit and see if what we've created so far is going to help the economy, or concern about, well, how much more do we have to keep pumping out there until the economy gets going again. But there's this, it's happened so quickly and in such a large amount that it's confounding to just, if you're just reading the newspaper once a week or watching the nightly news, of putting the pieces together to say the stock market and asset markets are doing what they're doing, but the economy is doing something totally different. And you're in this kind of dichotomy that is definitely, on opposite sides of the spectrum.
Yeah, it's very hard to get the stimulus down to the bottom. But, in what history we might be looking back 6 months or a year from now and having another like big political debate is that, again, you saved wealthy banking system and you saved pension plans.
The companies and the
and we're dealing with that issue right now and watching it play out because the stock market is saved, pensions are saved, but you're not getting that money to the bottom. So I think this is the question that came up a few times too, is just, do we have the ability with our communication skills to describe quantitative easing? And then I'll throw it to you too and just sort of say quantitative easing, the way it's stitched right now, are we going to get inflation? The stock market is based on, the valuation of the stock market is based on interest rates, and interest rates are based on inflation, and it's getting this single piece right is probably the most important thing we're doing. Yeah. And I wonder if you could tie that into...
Why don't I'll take a stab at QE, and then maybe you can talk about whether it's inflationary or
I got to answer the hard part.
Yeah, I'll answer
See if we agree.
Yeah, so I think in trying to break it down as simply as possible, I think the way we think about quantitative easing is that what the central bank does is they create money that then, in the U.S., for example, what they do is they'll digitally create money, and then they will buy bonds in the open market. So they go through a prime dealer, and basically, so you're creating money, you're buying bonds, and really the effect is you're trying to lower interest rates so that it then stimulates both asset market inflation and it affects mortgage rates, it affects credit card loans. Everything is priced off of a spread over what a government interest rate is. And so the idea is the lower that you create or you take interest rates and the more money that you flood into the system, it then frees up other money to price other assets or to go into other things that can then be stimulated because interest rates are kept so low. And so I think they started it. It's interesting going back in history. This has been done in World War II. They did a similar thing. I think a lot of people thought that the first time this ever happened was 08, 09, and it's actually been a policy used before. If you go back through longer periods of history, but really the idea is keep interest rates low. Financial suppression of rates, which then allows the rest of your asset market to create a wealth effect, which then can go into consumer spending. But the mechanics of it are very simple. It's the central bank prints money digitally, then they buy bonds, which lowers the interest rate of bonds, which then means everything can go up in value because everything is getting priced off of bonds.
Right. So monetary policy 101 is that it's asset price inflation. But if you are the money that is created and which comes to the consumer, if it is consumed and it's not used to build a new factory, plant, or create productivity in the economy, by very definition, it is deflationary. The asset price goes up, but the overall consumer inflation actually goes down. And this is the extraordinary thing. We've been sitting for 10 years with all this quantitative policy, waiting for when's headline consumer inflation coming back. And the reality is it's dead. It's dead in Japan, it's dead in Europe, and it's now absolutely dead here. And it's not pure printing press. It's actually, there's still the government is digitally creating debt that in theory has to be paid back. And again, this is incredibly tricky. When it was a certain size, it was interesting and important, but now it's almost like the only thing that matters to get right. And so inflation first. I think we've touched on this a couple of times, but this is still the wild card, and getting these wild cards right, which is it's not so. Our economy might be able to actually fumble its way through this, through North America. It's really this interest rate impact on emerging markets and in the developing world, and we're just starting to see it as currencies are dropping off, and Turkish lira, Argentinian peso, like all these things, and just I want to touch on that there might be this odd phenomenon where you think that the U.S. now has all this debt, so shouldn't the U.S. dollar come down? But we might get a different outcome. Yeah,
well, I guess on that we can touch on that a little bit, but I think that's exactly it. And it's taken a lot of I would say, I've had to be very mentally reflexive on this, because if you look at the numbers, if you look at the deficit, you look at the rate of growth of the debt in the U.S., and historically, when budget deficits and trade deficits together are very correlated to higher or lower moves in the U.S. dollar, and they have been over time. A lot of that has to do with the impact of the U.S. dollar as it relates to world trade. And so more trade going on in the world, more dollars out in the system, which then means they're circulating more, which then means there's less demand for them because people are earning them through selling their products. So the US dollar usually can weaken in that kind of an environment. And so, but the difference is now what's happened since 2009, so 2010, 11, 12, where US interest rates were on the floor at basically 0%. You had huge parts of the world that said, oh, great, I can now issue US dollar debt, because US dollar interest rates are almost at zero. The US dollar at the time was very low. So you had trillions of dollars globally in economies or countries where, the underlying fundamentals aren't great. Maybe it's a resource-based economy. Maybe there's, high levels of government corruption. There's not a really productive economy like we would think of in the West. And so now you have, somewhere around 10 to 15 trillion of US dollar debt out in the world with, countries that they don't have the ability to pay it back. And so it creates this short squeeze scenario where you have all these other countries in the world that desperately need dollars to pay their interest costs, to pay down their debt. But now in the shutdown, their revenues have gone to zero. And, commodity prices have collapsed, so your oil revenue has gone to zero. So you're creating this short squeeze dynamic in the dollar that is, you can see scenarios playing out where the dollar should be weaker, but, I've seen other people make the case that you're actually going to get a super spike in the dollar because of this short squeeze scenario. And I think that, so there's kind of a binary outlook on what the US dollar is or is going to do. And I think certainly there's the fundamental case of what it should be doing, but then there's also the, as the comment or the verbiage you used before is a market structure dynamic of the US dollar that could lead to a different outcome. So I think that's something that we're kind of paying attention to and watching very closely as well. But at the same time, making sure that we do maintain exposure to what we would consider to be very high quality US companies, because, we're not trying to take a huge bet on the currency either way. But at the same time, we know we still want to own great US businesses, and we've actually been able to pick up a number of them in the last couple of months.
Yeah, it tells us that we actually want to make sure we're in the US. But it also, again, highlights this point that the real economy is not the financial economy. Because if the US dollar goes up, it's terrible for the US exporting. It's terrible for a whole number of, global type US businesses, but it doesn't change domestic healthcare.
Yeah.
So again, when we've gone in and tried to focus on, from this scenario, this crazy scenario that the US dollar might get stronger, and we certainly don't want to get blindsided by one of those type of things. So make sure we've got a big amount of U.S. exposure, but it's in hard tangible assets again, and much more of a domestic focus to sort of insulate us from, from a real economic event like that.
Yeah.
I think the last one though is just, so it's you have this deflationary effect with the debt. You could get a currency moves that most people are not, and again, are not set up for this. And then the last one is that when you're through all this, we're still stuck with the same problem we started with, is that we have hard asset and monetary inflation.
Yeah.
And it's not necessarily that the assets are going up, it's that the currency and the value of the money is going down. And so I think this is when we say, well, are we nervous? Are we trying to run to the sidelines? I think it's trying to, every day we're just trying to say, can we build the portfolio with essential businesses? And even right now, we can say we talked about gold a month or so ago, but you had to be in it a month or so ago.
Yeah.
It's been an incredible move already.
Yeah. I think the other thing that's interesting, and it just kind of triggers something, but to what you were talking about a bit earlier in terms of whether QE does it cause inflation or deflation, or I guess the amount of debt in the system, is deflationary, but at the same time, the amount of money created by central banks, you have, you could have your economy exhibiting deflation at the same time your financial system is showing monetary inflation. it kind of feels like that's where we are currently, where even in March, you could say is that sort of panic period where it was a monetary deflation, but then a month later you've got back to, monetary inflation, which is stocks are going up, gold's going up, hard assets are going up, and people just wanted dollars in March financially. Now, I'd say currencies are probably, not what you want to own long term, of course, with how much are being created, but at the same time, you still have this structural deflation in the economy, and creating more debt is only going to be even further deflationary. And I think that's it's the hardest thing to understand, because the idea is, well, all this debt's being created, who's ever going to pay it back? But if you're creating more debt without an accompanying income stream to pay off that debt, then you're heading into an even slower growth, more deflation kind of environment. But if you create all this money in the financial system, you could have crazy monetary inflation at the same time.
Yeah,
And
two very specific,
Yeah.
very different things. Like in bringing it back to, like I said, and I hate to use any sort of jargon on this terms, but that goods inflation, which is you can produce anything you want. You've got way too much car capacity out there. So the price of cars might actually go down. Auto parts go down. But that hard asset, that thing that can't be reproduced, house, real estate, these store of wealth where we sort of gold, but we're trying to go in and find those handful of essential businesses. And again, in a pandemic, the companies that don't turn off, also being really, sensitive to price. And we try to rebuild the portfolio so it's not super expensive. We have these income streams, and we can actually get through this, just incredibly complex environment. But again, it's not like 12 months from now we've got to jump from all these horses onto the next horse.
Yeah, like it's not like you said that kind of the way you've articulated, I think is good, saying we're not, you hear people sometimes in financial media or pundits saying, look at all these great stocks you should own. This is the pandemic portfolio. But saying, the pandemic portfolio is not really the way to build a portfolio for a long period of time. You could trade this for 3 months, and then the things that are doing well now, in some respects, you're probably not going to want to own in a year. But there's actually, what we're trying to do is own things that are in a good spot now that you still also want to own in a year. So it's not the hyper pandemic portfolio, but it's businesses that we think are consistent and can do well over time, even in a better scenario. I think the other thing too, why don't we just touch on this quickly, but the concept of, we got this question of why are we seeing such a divergence between what you consider growth and value at certain parts of the economy? And then we were just talking before we came in, but this idea of a lot of the sectors that would be considered value today are actually very economically sensitive, whether you think of financials or energy or industrials, and maybe speak to that effect too, of saying, a lot of that value has been, wiped out because of how sensitive it is. But when we say value, we're trying to buy high quality companies at a price that we think is fair, rather than saying, we're going to buy something because it's a low PE or low price to book.
This seems to be the big, and what's even referred to as a value trap, and you get into what you think is a underpriced asset. And the Graham Dodd, the godfather of value investing, was, here's a dollar bill that trades on the stock exchange, and can I do the work and say, well, it's priced in the stock exchange at 50 cents, but there's about $1 of value. And this is what Warren Buffett took that idea and tried it a couple of times and realized, that's not what he's talking about.
Yeah.
It's a way to actually get stung.
Yeah.
And you actually have to buy a good quality company that's growing and has a way to reinvest in its own business.
Yeah.
And right now, it seems more than ever, we're filled with these value traps. And again, we picked on automotive already. There's automotive capacity to build any number of cars you possibly could want. It's much more structural problems than you got labor structural problems. And actually, maybe we just don't need any more cars than we actually do right at the moment. Mm-hmm. And there isn't the income to buy the cars at the moment. Yeah. So it's looking at, here's a good that is being overproduced, and it just doesn't have the fundamentals. And so as opposed to, those sort of essential services, and really, which we keep coming around to, is even software. You just can't run an accounting company. You can't run a bank. You can't, it's your core technology competitive advantage, and it's sort of what is being reflected in the stock market. And that doesn't necessarily have to be, some of those companies are really expensive, but we can come back and say these are these absolutely essential businesses that stay on, the ones we brought up a few times, again, not to jog too much, but you can't watch Netflix, which is an incredibly expensive stock, but unless you pay your Bell bill, you can't watch Netflix. So being extremely careful to avoid the value traps, being careful not to, take our hard-earned money and invest in something that's super expensive, but you also don't know whether it's going to be regulated away. There's also this big idea too, and this will be touched on in other times, that things that could happen is that the big tech companies have been undertaxed, and there's absolutely no reason why next year you could get a massive tax increase on basically the only pillar of the economy that's making tons of money and not getting taxed.
Right. Yeah.
So there's the really strong reasons to avoid those type of businesses. And as we really try to come up the middle and say, here's these great return on capital companies that we're not paying too much for, rebuilt the portfolio, very comfortable in it today. And again, trying to get from here to next year.
Yeah. Okay, well, why don't we wrap it up there, and we'll look forward to the next conversation.
Perfect.
Okay, great.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog, or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, Google, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.